Hey everyone, Ian King here with your Winning Investor Daily YouTube update. In today's webinar, I'm going to talk about a couple things. First, we're going to address the idea of whether or not we are in a recession. And if you do believe we are in a recession, and of course, we're already in a bear market in stocks, as you've seen with the NASDAQ down and the S&P both down over 20% this year. But then the question is, what should you buy? What performs best coming out of a bear market? And I'm going to share some data with you that really is unbelievable. So please stay tuned for that. But first and foremost, if you like our content, please go ahead, smash that like button, subscribe to our channel if you haven't yet, and feel free to leave any comments below. Of course, keep them nice. But let's talk about whether or not we're in a recession. And I want to pull up this chart of the US Index of Consumer Sentiment. So this comes from the University of Michigan. And this dates all the way back to the 1950s. And basically, it's a survey of how consumers are feeling. It's conducted once a month. And it has been very indicative of when it foretells recessions. So if you look at this, all of these gray lines here in the chart, the vertical gray lines, indicate recession. So going way back to the 1950s and 60s, we had three recessions in the 50s and then early 60s. And then we had a huge, and that wasn't really, you didn't see a huge drop off in the consumer sentiment. But things started changing. In the 70s, you saw a big drop happen, and then a recession in 1973 to 75. You had that recession in 1980, of course, when Paul Volcker raised interest rates to curb inflation. And then you had a recession in the early 90s that it was predictive of. The one that really wasn't predictive was the recession after .com, which was pretty short-lived, considering that the government after 9/11 started pushing a lot of money into the markets. And then you had, of course, the great financial crisis here in 2008, 2009, where sentiment dropped to about 50. And right now, you had a mild recession in 2020 during COVID, and consumer sentiment fell off. And right now, consumer sentiment is at the lowest it's been since the 1980s. And we're at a 50 reading right now. And one of the reasons for that is because interest rates are moving up as fast as they were back then. And inflation back then was running double digits. And now at 8%, we're pretty close to it. So this is pretty foretelling that we are heading into recession right now. And in fact, that's what the Fed is trying to do. They're trying to create a recession so that inflation comes down. This is the whole point of them raising rates at the fastest pace in history to stop consumers from buying so many goods and bringing the cost of goods down. Now, the question is, if you do believe we are headed into recession, which is what I believe, and you do believe that we are in a bear market, which is obvious, what is the sector that outperforms after a recession? So from the bottom of the bear market, what is the sector that will best position you for huge gains? So now I'm going to go back to a chart that I want to share from French and Schiller. They're two economists. And this shows the performance of small cap value from bear market bottoms. And if you look at this, you can see in the 1930s, after obviously, the Great Depression and the recession, the economy started to recover, you saw a massive rally in small cap value stocks into the mid 30s. So in April 1932 was the bear market bottom. And these stocks were up 1,200% in 5 years off the lows. That's the index up 1,200%. I mean, individual stocks were probably up 5,000% and 10,000%. Then in the 1960s, there was a bear market bottom in April 1962. And you saw small cap value greatly outperform as much as 500% returns in small cap value from about 6 years off the lows. Then in the 1970s, small cap value, which is the green line, obviously, and the S&P 500 kind of tracked each other. And then in the mid 70s, small cap value took off, rising 400% from the bear market lows. Then again, 1974, this was a big one. So between 1974 and 1984, 10 years, small cap value stocks gained on the average 1,500%. Then in 1987, after Black Monday, you had them rise about 500%. in 6 years. And then in December 2002, you had them outperform for 4 years, and they fell with a great financial crisis, and then they rallied again. So 200% return, you're looking at 8 years. And then again, after the bear market lows, in Jan 2009, small cap value has tracked much closer to the S&P 500. But I think this is going to change. I believe that small cap stocks, especially the ones that have enough cash to get through the bad times on their books, are the best positioned stocks to buy right now. Historically, they're as cheap as they've been since the early 90s. You can check out my research on that. We also did a webinar on it earlier this week where we share that data with you. So check out our Winning Investor Daily videos. Lastly, how do you pick these stocks? Well, we looked at a bunch of different factors. We put some research together to find the small cap stocks that are best performed to do well once the bear market bottoms. We put together a special webinar. Please check it out, Bear Market Fortunes. It's below me. You can click the link to check it out. Please take a look. We present all our research in it. And any questions or comments, please feel free to leave below. Thanks again for tuning in this week. I'll see you next week. Take care.